Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Last week on the Worry-Free Retirement, we talked about the 3 types of mailbox money. Today, we will discuss the only type available to all savers and why this financial tool is still the most misrepresented and misunderstood product of them all.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and 6-time author and fiduciary, Tony Walker.
In case you missed last week's show, the 3 types of mailbox money, and before we share with you the most popular of the 3, may I remind you of the definition of our trademark concept I created called mailbox money. Basically, mailbox money is any source of income that provides to the recipient, and here's the key word, a guaranteed income which the recipient, or in some cases recipients, can never outlive. Now, with this definition in hand, and assuming you are a saver in search of guaranteed income that will last as long as you do, the good news is that regardless of your age, economic circumstances, or yes, even health, option 3, something we refer to as a private annuity, is the only type of mailbox money that is available to anyone ready to get off their wallet and invest in them. Which is why today I'm going to explain the 2 types of annuity strategies that produce mailbox money, and thus debunking the many myths, opinions, and misconceptions surrounding annuities, so that you can decide for yourself if an annuity is right for you. So, let's get started. Well, welcome folks to the Worry-Free Retirement, and yes, I am that little man in the sweater vest, the annuity king himself, retirement planning specialist and full-time fiduciary, Tony Walker. And before we educate you on the 2 different methods that annuities provide this beloved mailbox money, let me introduce to you in this Worry-Free Studios on this beautiful October 24th, 2023, America's favorite financial sidekick, Mr. Aaron Orander. Good morning, Aaron.
Hey, good morning, sir. How are you?
Doing well, doing well. And man, the month's flying by, isn't it?
It is.
Can you believe Trick or Treat's just around the corner?
I know,
what are you going as
week
this
away.
year? What are you going as?
Do you really want to know?
Oh, are you going to really dress up?
Oh, yeah. We've got like family costumes.
Oh, no, don't tell me.
Yeah, we're
like
doing, have you seen those inflatable costumes? You know, they've got a little like battery powered fan in them, so you turn them on and they get real big. I'll have to show you a picture.
Oh, my gosh. Can we get a video of that or a picture at least for the TV show later?
Maybe.
Okay.
We'll see.
That's hilarious. Okay, Aaron, you hear me talk about mailbox money, and some people kind of laugh at that and they'll say, well, who in the world gets a check in the mailbox? I mean, everything's direct deposited, but have you ever in the past, in your working adult career, literally received a monthly or biweekly check or whatever from any employer in the mailbox?
Well, yeah. I guess you don't remember this. Probably about, I've been here 10 years, and I would say probably the first 4 or even 5 years I worked for you, I got my paycheck in the mail every 2 weeks. What Gina and I refer to as the Plainview days. That's when our office was over in the Plainview area, and it was just Gina and myself up here in the Louisville office. Every other Thursday we would anxiously wait on that FedEx package.
That's funny. I forgot all about that. Yeah, so you've enjoyed mailbox money in the past, although it's direct deposited now. It's all the same thing, folks. Okay, assuming you're like all the savers I meet on a weekly basis, that is, you're more concerned about the return of your money as opposed to the return on it, let's set the stage with my typical day at work. All right. A saver who has watched my TV show, or in this case, listened to the weekly radio show that you're listening to, responds by taking advantage of a very unique process we start with called the free 10-minute fiduciary phone call. And upon learning whether we can help or not, then if we think we can help, they're going to do the next best thing. They're going to meet with myself, that's right, the owner of the company, or you're going to meet, depending on the circumstances, with one of our highly trained fiduciaries. And Aaron, think about this. Let's say you have never really worked with an advisor, or maybe you're just perturbed with the whole financial world. Especially, let's say if you had a big 401k with one of these huge companies. Can you imagine getting to meet with the owner of the company to sit down and literally share your goals and values and what you want for the future? Pretty cool, isn't it?
Yeah, it's big time.
And in fact, every once in a while, there'll be somebody come in, and generally it's the female that's confident that she and her husband are going to meet with me. But every once in a while, they'll sit down and she'll look at him and say, "I told you so." And he'll kind of smirk, and I'll say, "Okay, what's going on here?" And he said that we were not going to get to meet with you. And I said, "Hey, I say that we're going to meet." He still didn't think. So people, yes, you have to understand the reason I have so many staff members now, we're up to 17 full-time staff, is because as our clientele is growing, we have over 3,000 clients now, I want to make sure I have the time to meet with not only my current clients, which I will do that at any time, I'm always accessible to them, but meet with you. So again, if already you're sitting there saying, "Man, I got to get a plan." Maybe you were just laid off. You've recently received a large lump sum. Had somebody call in yesterday, Aaron. She just was notified she's getting a huge inheritance. She doesn't know what to do with this money or who to trust with it. Maybe you've got a 401k, a lump sum pension, money languishing over at the bank. Or maybe you just really need a retirement game plan. You're tired of all the stock market ups and downs and people telling you to hang in there. Well, this is really easy. Again, to meet with me in person, we first start with a phone call. It's called the fiduciary phone call. You log on to TonyWalkerFinancial.com. Once we do that, if we need to meet, we can either meet in our Bowling Green, Louisville, or Lexington, Kentucky offices. Or right now, if you just want to give us a call at 877-499-9255. All right, so let's take it to the next step. Let's say I'm literally meeting in person with somebody. They filled out our proprietary, what I call the worry meter, which is trying to gauge what someone is really worried about, their biggest concerns. And Aaron, as you can imagine, I mean, with the tumultuous stock market, with wars brewing all over the place, with inflation, of that list, obviously running out of money has got to be one of the top picks, correct?
Yeah, absolutely.
Yeah, I mean, it just is. So what is the only guarantee that saver has? Can they invest in stocks and bonds with us? Yes, they can through our Charles Schwab platform. Can they invest in CDs and money markets, which as of the date of this recording are well over 5%? Can they get those through us, through Charles Schwab? Absolutely. Can they buy gold? Actually, no, we're not into gold here, folks. But let's just stay with those two. Stocks and bonds and CDs, which are paying a high rate. So again, I'm going to ask you a question, Aaron. While the stock market may do great over the long term, and while CDs are paying a high interest rate, assuming somebody might live 30 years, are any of those products guaranteed to provide a certain income for life?
No.
No.
Guaranteed?
Guaranteed.
No.
So there you have it. So what is the only product that guarantees an income for the rest of your life? Drum roll, please, Derek, as he edits this show. That's right, the annuity. So when we come back, I've never done this before. I'm going to take a deep dive and to explain the two forms of mailbox money that a private annuity, such as the ones we sell at Tony Walker Financial, how these things work, the pros and cons of both of them, the misconceptions that are not true, and more importantly, how does it work when you start an annuity income and get this mailbox money? How much do you know could be or might be or will be left to your family after you die? I'm Tony Walker. You're listening to The Worry-Free Retirement. We will be right back. Are you retired or retiring soon? Do you have a 401k, IRA, 403b, TSP, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government essentially has a lien on your 401k that can tax as much as 40% of your money when you go to take it out. And with current tax rates set to expire in 2025, and considering the fact that our nation's debt is spiraling out of control, do you really think taxes will go down after 2025 or go up? Here's my advice. Don't sit around waiting to see what Uncle Sam will do to your taxes in 2025. If you have more than $250,000 in retirement assets,
Contact us now by logging on to TonyWalkerFinancial.com or give us a call at 877-499-9255. In the financial world, advisors are often divided between two categories: money managers or annuity specialists. My question is, why not have both? At Tony Walker Financial, we specialize in investments and securing guaranteed income you can never outlive. You know, we're more than just annuities. So if you're retired or retiring soon, why don't you give us a call or log on to TonyWalkerFinancial.com and let's get started. Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no-obligation appointment. Let us help you today.
Welcome back to the Worry-Free Retirement. In case you missed last week's show regarding the three types of mailbox money, man, it is a dandy and is going to really help you understand what we're talking about today if it gets a little confusing today. But a lot of people don't realize this. Aaron, you and Derek and even Trey, who helps with this, done a great job of posting stuff on our YouTube channel. So we can we've got a blog page. We've got all of our past episodes. I mean, how much content do we have on that YouTube channel? It's crazy, isn't it? I mean, almost endless.
I'll put it this way. We've got more than anybody else you're going to find.
Yeah.
I'll just put it that way, not to snuff the competition out, but we've got more out there than any other competitor.
Yeah, I was going to say, speaking of guarantee, I can guarantee you that. In fact, I remember years ago we went to a place in Louisville thinking about doing some work on our website, and they were very sharp people. And he looked at me. I think you were in the meeting, maybe, Gene. I can't remember.
Oh, yeah, I was there.
He said, here's your biggest problem. We said, what's that? You have too much content. Remember that? He said, most people come in here, but since we have our own production studio, we got you and Derek. Yeah, we're on. And in fact, what episode is this of the radio show? Do you know right offhand?
So this is episode number 353.
And then later on today, we'll do the TV show. What episode of the TV show will we record today?
That's going to be episode number 487. We started doing the TV show about 2 years or so, or 3 years before we did the radio show. So we're not on the same numbers per se, but yeah.
So folks, if you say, gosh, yeah, I want to check some of these videos out and former TV shows, go to youtube.com, search Tony Walker Financial, and it'll kind of prompt you from there. If you want to listen to past radio shows, the best way really to find it and also find out the different stations and TV stations and radio stations we're on throughout Kentucky and Southern Indiana, is go to TonyWalkerFinancial.com, TonyWalkerFinancial.com. Up in that upper right portion, click on those little lines that'll open up the menu box. Click on radio and TV showtimes, scroll down, you'll see all of that, and you'll see the recordings of all of the former radio shows. Highly encourage you to do that. Okay, today we focus on the only type of mailbox money available to anyone who can still fog a mirror and who's got a little money in their pocket. It's called the private annuity, a product we at Tony Walker Financial offer. We're known around the country for the amount of annuities. I've written close to $600 million of fixed indexed and fixed interest annuities. We have our proprietary software. Folks, we have been doing this a long, long time. And unlike our typical array of products served by us and some of the rest of the financial world, that's the stocks, bonds, mutual funds, bank CDs, blah, 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 all that stuff that's been offered for years. Remember, annuities are the only one of those options that can provide guaranteed income for life. But there's a problem. Since the financial world and a lot on Wall Street, some of them are starting to come around to it, but since they don't really understand these products, for the most part, they're getting there. They're trying to learn how to charge recurring fees on them, and some of these companies offer annuities now that can pay these advisors recurring fees rather than commissions. But for the most part, they poo-poo these annuities, and they've always replaced annuities with a theory, and it is a theory, Aaron. This is not fact. It's called the 60-40 rule, and what they mean by that is in general, now it can be different percentages, but in general, what they've always said is put 60% of your money in the stock market, and then 40% of your money in the bond market. Is that kind of making sense? It's like you're splitting it up.
Sure.
Okay.
It's almost even.
Almost even.
Okay.
And then sometimes it may be 40-60 or 50-50, but the idea, here's the idea, and it is a theory, and we're going to prove in a minute why this theory has really tanked here of late. But the theory is, in most cases, when stocks go up, bonds go down. When bonds are up, stocks are down. So over the long haul, Aaron, you should have a nice, steady return, and you should never worry about running out of money. Well, guess what?
That's not the case right now, because we've talked about that several times on the past several episodes. That's not the case right now.
And in fact, it's alarming because Schwab did a study on this 60-40 thing. In fact, let's do this. Let's go to my favorite nephew and fellow fiduciary, Wes Walker, who's kind of in charge of helping select a lot of the investments and tracking this type of thing. And let's turn over to Wes the results of this survey.
Well, thanks, Tony. Yeah, conventional wisdom does hold that a 60-40 portfolio of stocks and bonds should perform in most economic environments pretty well. Problem is, in 2022, we had this odd thing happen. Interest rates went up faster than almost any other time in history. And what interest rates do, they put pressure on asset value, so stocks go down. What they also do is they reduce the value of existing bonds. So a double whammy if you're holding this portfolio of stocks and bonds. Really, the only thing that can guarantee an income in retirement are annuities.
Incidentally, if you are wondering why many advisors have for years poo-pooed the use of annuities, there's a great article, and it's interesting. And basically, here's what this article says. I won't read you all the details. It basically says this: most advisors have never sold annuities because they are not familiar with them and don't understand them. Now, on the one hand, Aaron, I'm fine with that. There's certain products and investments I don't understand. I don't sell them. To me, they're not geared towards savers, so that's fine. But the problem is, I'm not going to, let's put it this way. Let's say if somebody wants to invest in pork bellies, and they know a lot about pork bellies and I don't. Well, I'm not going to tell them not to invest in pork bellies, right?
Sure.
If they feel comfortable with them and understand them, I don't deal in pork bellies, that's fine. But for somebody, just because you don't understand annuities, to tell people annuities are bad, I don't think that's right, do you?
Right.
Yeah, it's almost crazy. So let's get to the meat of this. Let's figure out how a private annuity issued by an insurance company can provide this mailbox money. Well, basically, there's two forms, okay? The first form is called annuitization. I'll cover that in a second. And the second form is called the lifetime income rider. Now, annuitization is basically a period of time whereby the annuitant, that's the person that's going to receive this mailbox money, will receive mailbox money for a set period of time. It could be for their life. It could be for a period certain. It could be for a period certain for their beneficiaries when they die. And more times than often, it's a period of time that also provides mailbox money to their spouse. So, Aaron, that way, if you wanted to set up mailbox money for Jessica, you annuitize it. You would say, hey, Tony, when I die, if I die first, I still want Jessica to get some mailbox money. Could be 100%, could be 50%. Okay. Now, these selection folks, you have to understand something. Let me give you an example. Let me get my cheat notes out. Our own Lisa Allerkamp in our Bowling Green office ran these for me. All right, let's say, just for the heck of it, you're 70 years of age. You got $500,000. You're so tired of the stock market. You just realized bonds went down almost 20% last year. You thought they were safe. And you're just saying, man, I'm burned out. Oh, it's funny, Aaron. I keep jumping around here. As of the date of this recording, October 24th, 2023, the UAW, guess what they want employers to bring back? You remember? What is it?
Pensions.
Pensions. Folks, that's mailbox money. A pension is an annuity. And I don't mean it's funny, but it is so interesting that after all these years, the great savior was going to be the 401k, and employers got rid of pensions. Folks, the reason employers don't want to offer pensions is because they're expensive as all get out. And basically, the employers are saying, we're not offering these pensions anymore. So you've got to get your own pension, a private pension, and that would be a private annuity. So in this example, we take $500,000, and let's say we're meeting with a couple, and this came in yesterday, Aaron. One of the spouses has cancer. Maybe not expected to live a long time. The other spouse is very healthy, has a long life expectancy, okay? So they're going to say, well, I tell you what, Tony, I'm just going to, the spouse that's healthy says, I just want the income paid for the rest of my life. Isn't that going to provide the highest amount? So, and again, there's different rates out there. We just grabbed one of our companies. So that's called a single life annuity. In other words, if this person invests this $500,000 with the insurance company, they are guaranteeing the one person $26.95 a month for life. They could live 80 years and it doesn't matter. Pretty good, isn't it?
That's good.
Okay? Guaranteed. Now, the problem with a single life annuity, and some of you have done this on your pensions. I met a gentleman the other day that did this. At the time he took his pension, Aaron, he didn't have a spouse. Well, naturally, why wouldn't you take life only? That's the most money, right? I mean, why would you leave a beneficiary? Well, since that time he's married, problem is he can't change this. The election's been made. Okay.
Oh.
So that's the highest form of payment because the insurance company knows that they're on the hook for only one life. So again, when you do a single life, when you die, the income stops. There is nothing left to anybody. That's called annuitization. Let's say they say, well, gosh, that's no good. I mean, what if I did die? I want to leave something. That's called a period certain. So in this case, all right, the person says, well, how about this? What if I live only 3 years and die? Could I at least leave some of this income to somebody? My spouse or children? Yep. In this case, this is called a single life and 10-year certain. Okay, so you give them the $500,000, but notice, Aaron, instead of $26.95 a month, the monthly payment to you for the rest of your life drops to $25.91. The reason they're doing that is the insurance company has the risk of having to pay this out guaranteed for 10 years. Well, that could happen, right?
Sure.
So they're going to pay you less. All right, now, final option. There's a bunch of these options. Even you teachers out there know there's even a pop-up option. So if you do what I'm getting ready to describe and one of the spouses dies, it pops up to the higher amount. We're not going to get into pop-ups. But anyway, this is very popular. This is the one my grandfather had. It's called a joint life with survivor option. Now, he had a 50% survivor option, but what if you say, okay, I want income for the rest of my life, Tony, I want mailbox money, but if I were to die, I want my spouse to get the same amount. In other words, 100% of the monthly amount continues on to them. So remember, if you did a single life, they're going to pay you $26.95. Now the insurance company is going, wait a minute. They get with their actuaries. What if we have two people on here? Their chance of one of them living a long time is pretty great, isn't it, Aaron?
Yeah.
Well, they're not going to pay you as much money, so the payment drops, what is that, pretty much over $400 a month to $21.93 a month.
Man, that's a big jump.
Big jump, especially if one of those spouses dies, the other one's stuck with that lower amount for the rest of their life. So that's annuitization. It can be done. They're not as popular. It is viable. Don't get me wrong. The problem with annuitization for mailbox money is it's irrevocable. Once you set up that election, you cannot change it. All right, put those notes back down. Get my other cheat notes out. Now we're getting ready to explain the most popular type in modern day annuities and mailbox money. That's called a lifetime income rider. Okay, that's the lifetime income rider. Let me get over here to my little fancy schmancy definition. Okay, the income rider is basically a deferred annuity, private annuity, providing mailbox money, and it's based on three factors. One's called the roll-up rate. The other factor is, do you want to include a spouse for joint life income or just for your life? And also, it depends on when you start drawing money. So let's go back in time. Somebody has $250,000. They're age 60, but they're not going to need money for whenever. You can start this income at any time, by the way. You can start it in the third year, fifth year. But in this example, we're going to kind of go back in time. This couple invested $250,000 in a annuity, let's say, with Tony Walker Financial. It had an income rider. It's a deferred annuity. They can start income anytime they want. But we're just so we can make a comparison, we wait till age 70, just like the folks in our earlier example with annuitization. So now age 70 rolls along. The roll-up rate on the annuities, and this is guaranteed. We have companies offering this. As long as it's in deferral, this particular roll-up rate or interest rate is compounding at 7% guaranteed. That's a pretty good rate, isn't it, Aaron?
Yeah.
7%.
7%?
Yeah, but the catch is, to get that 7%, you have to take mailbox money. Folks, many of you come into me and you've bought these types of annuities. You thought you could just yank all this money out lump sum, 7% and all. That is not the case at all. Even bonuses. This company pays a 10% bonus. Heck, we've got a company on an income rider paying a 40% bonus right now. Folks, those bonuses in most cases don't necessarily go to you. They're used in the calculation of your future mailbox money. So this is why you better know what you're getting into. If you're right now even thinking about buying an annuity and it sounds a little too good to be true, please get a second opinion from us or better yet, download my free guide called Annuities Made Easy. You can find that at TonyWalkerFinancial.com. It's going to really help you understand these products before possibly getting stuck in the wrong annuity. All right, so let's see what happens. Now we fast forwarded. They put in their $250,000. They got a 10% bonus up front. It's been earning 7% guaranteed. We fast forward to the 10th year, and it's worth the same amount, Aaron, as our annuitization, roughly $500,000, right?
Okay.
That's guaranteed. All right. So they say, all right, I'm ready for my mailbox money. How much will that be? Well, this is pretty good. Now, Aaron, tell me how ironic this is. All right. Remember, our single life annuitization on $500,000 is about $26.95 a month. You with me?
Right.
Okay. This on a joint and survivor, okay, is actually $27.61 a month. So it's actually a little higher.
Yeah, a little more.
A little more. But that's for your spouse too. Whereas if we do a joint and survivor on the annuitization, it's only $21.93 a month. Plus, listen, folks, this is why these modern day annuities that we use, I think, are much more flexible and better for you. Plus, remember with the joint and survivor annuity, if you annuitize it, let's say you and Martha are driving down the road and killed in a common accident, income's gone. It stops. Nobody gets anything. With the modern day annuities, you and Martha get killed in a common accident. If there's anything left in that annuity, let's say you've been drawing it out for a few years and there's maybe $200,000 left in it or whatever it is, that all goes to your kids. So here's what I like to say about the modern lifetime income rider annuities that we use. We do a lot of these at Tony Walker Financial. I like to say it this way. Worst case scenario, you or your kids will get back your original principal, come heck or high water. And that is the biggest misconception because, see, a lot of people who don't understand annuities, they're thinking annuitization. And that's when you hear people say, well, don't take that out because when you die, there ain't nothing left. Well, even with the modern day annuities, depending on how you live and how long you live and how long you draw out the money, true, there may not be anything left. But if you haven't drawn out all the original principal you put in, the balance of that original principal at your death still goes to your loved ones. So here's my point, folks. If you're sitting there and you are tired of, I had a gentleman calling yesterday. It was one of the funnest conversations I've had. Pretty sophisticated investor, Aaron. He's getting up in his 60s. He's like, Tony, you know the reason I'm calling you? I stumbled across your TV show. You had your whiteboard out. I thought, everything this guy's talking about is the way I think too. I'm tired of chasing returns. I'm tired of chasing CDs. Tired of hearing my broker tell me to hang in there. Everything will be fine. I just want to relax and enjoy my retirement and quit worrying about running out of money. Those were his words because he had heard me talk about it on TV. Well, that's you right now, folks. If you're sitting there thinking, yeah, this is crazy. Feel like I'm chasing my tail here. Feel like everybody's making more money on my money than I am. I want a plan. I want an advisor I can trust. I want somebody local I can meet with who is a fiduciary, who knows a thing or two about this world called retirement planning. Then we know we can help. All you got to do to learn more about our services right now, just log on to TonyWalkerFinancial.com. TonyWalkerFinancial.com. There's a little red box that immediately pops up. That's where you set up your free 10-minute fiduciary phone call. When you click on that, we're going to call you back. And then we'll have this phone call. And if it warrants, if we feel like we can help you, we're going to set up a personalized meeting in person at either our Bowling Green, Louisville, or Lexington, Kentucky offices. We're going to go through a free analysis of your entire situation. That's everything. Provide you a free game plan. Heck, most advisors won't even give you anything unless you turn all your money over to them. We don't work that way. Absolutely free. We're going to give you the game plan, let you study it. Then, and only if you're comfortable working with us, we're going to move all that money over to Tony Walker Financial through our proprietary split IRA process. We'll select the annuities. We'll set up the Schwab accounts. We'll do all the distributions. Our tax certified specialist on hand at no additional cost. We'll figure out the withholdings for taxes. Folks, it is a one-stop shop. We want you to enjoy retirement, not worry about it. So, TonyWalkerFinancial.com, or if you like, just call us right now, 877-499-9255, 877-499-WALK. Anytime you can call us, even if we're closed, the answering service will get that information, pass it off to us, and we will follow up with you in short order. Well, we've sure enjoyed talking to you about mailbox money and the two forms offered by annuities. But if you remember, between now and next week when we cover a brand new topic on the worry-free retirement, if all else fails, you be worry-free and make it a good one.